Good day, Professor Simeon and fellow classmates. This is my industry use case presentation where I focused on the financial industry. It is titled AI and Analytics in Financial Services, where I looked at the adoption, risks, and the future outlook on Wall Street. Why the financial industry? As the saying goes, when Wall Street sneezes, the rest of the world catches a cold. This signifies the importance of the financial industry, and especially in the context of AI adoption. The financial industry is a data intensive sector, one of the most information rich industries, ideal for studying AI driven decision making at scale. The case study presents a broad source coverage and also personal relevance. The AI and the information in this industry parallels my own background in procurement, supply chain, and business analytics. And just for the general snapshot of the industry, 84% AI adoption has already taken place in the financial industry or the financial services industry. And it is shown that 60% efficiency gains has been found with dedicated AI teams, and 52% of firms already use agentic AI. The business problem. How can financial institutions use AI to boost productivity and cut costs while managing the disruption to their workforce, competitive landscape, and cybersecurity? So we're seeing the application of AI and the investment in AI by commercial banks, for example, JP Morgan investing 18 billion in AI tech, a budget of 18 billion. We're seeing hedge funds that are replicating investment workflows, hedge funds such as Citadel, Bridgewater, private equity firms such as Carlyle. They're using AI in enterprise search and due diligence. And fintech firms like Kraken, they're using proprietary AI product tools. So, in summary, 4 in 5 bank leaders feel they cannot adequately defend against AI powered cyber attack. So this is the need for AI, the AI investment to ensure that their institutions are protected while they're boosting productivity and cutting costs, etc. What's working? The productivity case from 3 perspectives. One, technology investment. JP Morgan's generative AI platform reaches 200,000 plus employees. Agentic systems like Bridgewater's AIA labs are replicating entire investment workflows. Changing talent needs. Some firms now prefer liberal arts hires. And 3, economic upside. Specialized AI talents are now commanding upwards of 275,000 in salary per year, while executives are reaching 2 million. It is important to point out that most firms are still climbing the maturity curve. JP Morgan and Goldman Sachs operate near the analytical competitor stage, which is the aspirational stage for most firms within the industry. The governance gap. Productivity is outpacing oversight, as we have found through the research. Adoption versus maturity. 81% of firms use AI at some level, but only 40% have reached the advanced stages. We also see cybersecurity exposure, where we see the same AI capabilities driving productivity are being weaponized by attackers. And also, we found cultural friction where hedge funds presents for secrecy clashes with the open collaborative norms that AI researchers expect. Regulation, ethics, and global reach. Regulation is catching up. US consumer protection laws apply to algorithmic lending decisions just as they do to human ones. The EU AI Act classifies credit-related AI as high risk, requiring transparency and oversight. 3 ethical fault lines. Algorithmic bias in credit scoring and fraud detection remains under addressed. Second, the black box problem, outputs that are hard to explain to clients, boards, regulators, and fiduciary duty questions when AI drives investment decisions, as at Bridgewater. So the global patchwork, United States regulations apply regardless human or algorithmic decisions. The European Union AI Act treats credit scoring as high risk. Singapore has their own regulations, Indonesia and Malaysia, along with many other countries having their own regulations where AI is concerned. My summarized analysis. AI adoption in financial services is economically sound and highly effective, but soundness in productivity does not equal soundness in governance. So it's real, not speculative. Cost and time savings at Morgan Stanley, Goldman Sachs, and Thomas H. Lee reflect actual operational change, but governance lack. Only 40% of firms have matured past basic adoption into real bias and accountability controls. The future is accountability. Competitive advantage is shifting towards firms that can prove their AI is fair, explainable, and well governed. Personal reflection. What surprised me? I knew AI was used in finance, but not how deep and operational it had become, from investment workflows at Bridgewater to shifting hiring preferences towards liberal arts background. That's a surprise. Why it matters to me, the regulatory themes around explainability and bias directly inform how I will evaluate AI-enabled procurement and forecasting tools in my own work. Looking ahead, this research sharpened my understanding of where AI is headed next and how productivity and governance must advance together. The takeaway, financial services proves AI can deliver real productivity gains at scale. The next competitive frontier is proving that AI is also fair, explainable, and well governed. Thank you.